All right. Good morning. Good morning, everybody. We're looking at the founder's note. I guess I got to finish doing this or you're not going to be looking at anything. Yeah, there you go. So we're looking at the founder's note here on Spot Gamma. And what they're talking about is what's going to happen today with CPI when it comes to the optionality of the marketplace. And they're only hypothesizing, right? It's a theory. It's as good a theory as anything else, right? But it's not law and it's not fact. They don't know for sure what's going to happen if price goes up or price goes down any more than you or I do. But from the history of optionality, what we've seen out of them before, then we've got a pretty good idea what would happen if price does rise or price does fall. So it's not like they're just shooting in the dark. They do have some history behind it. So they're looking at the VIX positions being rolled Wednesday, right? The VIX is going to expire Wednesday, and then we have OPEX on Friday. And they're talking about the crowded bullish trade. They're watching 4,900 in the SPX, not the ES, as superior material support. So they're watching that area. Should 4,900 break, it could invoke a larger prolonged decline with a jump in implied volatility. They think it's really possible that we go down and tag that level and then come back up off of it. So they're not looking for a break below. The map forward pricing shown below, the next several sessions we're giving edge to the idea of consolidation down into 4,900 level. That's the base case, is that any dip to the 4,900 level would be bought. Now, when I first read that, it implied they thought we were going to 4,900. But if you kind of circle back through it, they're not necessarily saying, I think we're going to 4,900. What they're more saying is, if we go to 4,900, it's very likely we're going to get bought right back up off of the 4,900. To the upside, bulls have control if the S&P is greater than 5,000. That's the SPX, not the ES. Due to the decay and the shifting of this week's VIX expiration and OPX positions, the upside for this week may be capped at that 50-50 level, with 5,000 currently the fair value support strike. If the S&P comes out of the next week trading the post February 21st NVIDIA earnings at a greater level than 5,000, it is a signal that the bullish trend is likely to resume into March, and what they didn't right here, into March FOMC. They do have a couple pictures. I like pictures. Kind of maps out resistance, 5,100. Bullish greater than 5,000. Neutral at 5,000 to 550. All of that put into a box just considered bullish. I kind of like that additional box there. Bearish below 5,000 with support at 4,900. Major risk off if we get below 4,900. And I'm going to add to that. Look, there's a lot of times where we put a line on the chart and we say, all right, bearish above, or, bearish below, bullish above. It doesn't mean as soon as we wick down into that level that you want to, run out and short that sucker. If we go bearish below 4,900, we're looking at 4,500. So, it's not like you got to run out and get them as soon as we get to 43.99.99 and just jump on it with both feet trying to short it. If the short is true, then there'll be plenty of room to the downside. Bear traps are a real thing. And that line in the sand where we say bearish below is where the trap exists. We want people to fall for the trap. That would be the sucker that goes in and shorts it as soon as we cross through that line in the sand. You're the bear getting trapped. So if you don't want to be the sucker getting caught in a bear trap, then don't short it as soon as we cross the line. Same thing with bull traps, right? We had some really nice setup for some bull traps yesterday. We didn't get them. Anyways, this is spot gamma. There's always questions about these levels from spot gamma. They want you to buy their product. So they put educational videos on YouTube that explains every part of their product for free. The videos need to be free because if you don't know what their product does, then why would you buy it, right? Nobody wants to buy it and then learn. So there's this disconnect. Because of me, you're getting access to these tools and you've never had to worry about it because it's not your money. You're not spending anything. What do you care? If you want to learn how to use these tools and still it doesn't cost you anything, go to YouTube, type in spot gamma and ask your question. Spot gamma, volatility levels, call wall, whatever thing it is that you want to learn about spot gamma's levels, go to YouTube, type the word spot gamma first, and then type in whatever it is that you want to learn about spot gamma's levels. I don't work for spot gamma. I don't want to spend my morning briefing explaining how their tool works. CPI today, we have the chance for a liquidity gap. I love this trade. When it works or when we get it, it's great. We kind of had an opportunity Friday for the gap close play, but the whole thing was done and dusted before the bell even rang. Having said that, though, when it comes to event days, the event candle can become the thing that you use to analyze and project levels for the rest of the trading day. So this is a typical liquidity gap that we want to play. It doesn't matter if it's non-farm payrolls, CPI, PPI. It'll be one of those three, an 830 candle, a single directional push. So here, a move to the downside. That is the gap that we want to trade. And yeah, I know you don't see a gap, you see a candle, but we're talking about liquidity gap, right? The idea that price wants to go back to where this event happened. And this setup happens all the time. If you look at your futures chart, you'll find these large candle prints all over the place. And to various degrees, they're kind of the same thing. This is just the bigger model of that, kind of the best model of that. So this is what we're looking for. Typically, the gap gets closed around 11 o'clock. In this example, that's what it took until about 11 o'clock, and then we got back to where the candle started. Here's a different example, a different day, 8:30 print, single direction, got the gap closed around 11 o'clock. Here's a different day, single direction, basing pattern, got it closed around 11 o'clock. Now here's just last week on the 9th. Single direction, but we had a lot of wick across the top. None of those others did, and we don't want that. We don't want a wick on both sides, and we don't want it giving a lot across the top. But it was still greater than 50%. So technically, we could try to run it as a gap close. It got the gap closed before the bell even rang. However, we can use those big candles, not just CPI and PPI, but in general, we can use big candles, especially if they are event candles. This is not new logic. If you got into any sort of anchor education with the VWAP, they'll talk about anchoring a VWAP to a specific event, a gap up, a large volume candle, and earnings, all sorts of events get anchored. So it makes sense that we can go in and we can analyze one particular candle and lay our projections out from that as well. The half back is the 50% mark of that event candle, and it was a level of interest multiple times. So certainly something you would want to keep your eye on. So these have been examples of what it looks like when it works. I always like to show examples of what it looks like when it doesn't work, so that you know, don't even bother trying to attempt the trade. This is what we don't want to see. So if it looks like this, we just move on. We're done. We do a different thing. So we don't want big wicks on each side with price closing near where it opened. Here's another example of that, another example of that, and another example of that. So just continued examples of what we do not want. That big, wide brush in both directions with wicks on each end. If that's what we get, there is no gap trade to play. Easy enough. NASDAQ is down near to 0.75%. S&P a little more than a quarter with the Russell behind it. Hong Kong is basically flat along with the Dow, and Japan is the only one mildly positive, but really not enough to do anything with it. It's really the only thing we have today, other than some Fed speakers, is this CPI data. So last Friday, we had CPI revisions. Today, we're getting CPI data. There's been a lot of talk about the 10-year and the dollar moving with the market instead of against the market. Remember last year, we could look at the Dixie, the DXY, and the 10-year, and if it was going up, then we had a bearish S&P, a bearish NASDAQ. We could try to look for short opportunities. And if the 10-year and the dollar was going down, then we could look for long opportunities. But that really hasn't been the case lately, and it's just going to get worse. So, as much as that metric was, useful in its time, it's really a done deal. There's not much to it anymore. Now that can change. We can go back into the old ways, but until it does change, you're going to want to do something else. You want to look at something else. And it's not to say that you don't want to watch those moves, because you do want to know what's going on in the 10-year and the dollar through the trading day. They just don't have the same, tick by tick impact that they used to have. All right, we came back down into the call wall this morning, tagged it from above. A lot of these levels aren't going to matter until after CPI. Pivot points and call walls, all of that stuff is irrelevant during the event. So when we get the data and we start whipping and bouncing all over the place, none of those levels are going to matter. They'll only matter once things start to calm down a little bit. We can see that we have a lot of volume today. It's sitting at 102. At the same time, we can see that they are hedging today. This is not a guess. It's not my assumption. We know for a fact that they are hedging this morning, but they are also trading this morning. So it's a little bit of both. We got a late start to the kill zone move, but we did get a move through the kill zone. Oftentimes that creates its own little liquidity gap that needs to be closed. Not so much this morning, but it was a late start anyways. We are a lot closer to the lower ADR, which happens to be a cog line, 5011. And just below that, we have the weekly pivot point. which again won't matter during the CPI move. It'll only matter after the CPI move. We'll just go back to this day. When this data print came out, any pivots that were around it didn't matter until after this candle had closed. It'll be the same thing today. We do have an MDP. It's a missed daily pivot, but it won't count until tomorrow. Because of this hedging, we could see a greater move today than just the ADR levels. So this yellow line down here at 48.90, we would take the market maker move and subtract it from this level, and we would get a level even farther down, closer to the 0 gamma and volatility trigger. So that would give us like 49.74, something like that. It'd be right in this zone if we put the market maker move to it. If we happen to go to the upside, since we are so close already to the lower ADR, we've got a lot of pivot points to get through first before we could even get to the upper ADR. So we got the previous week's close, a regular daily pivot point, the previous week's high, then the ADR half, yesterday's high, the ADR full, and then we would add a market maker move on top of that. Another 16 points to 78. So it'd be like 94, right? Somewhere way up here. This very much looks like a blow off top. That's what a blow off top looks like. There was a lot of divergence yesterday on cumulative delta as we were up in this zone. As soon as we got this peak, cumulative delta started falling across the board. So it wasn't much of a surprise when price tried to retest those highs and couldn't even match the highs and fell down. There's nothing else on the table today more important than this CPI print. It's the biggest thing on the table. Let's see if we can add to this. We're looking for 0.3 core CPI and 0.2 headline with year-over-year core at 3.7 with headline at 2.9. The odds of a March cut are now down below 20%. And so if we get a cool print, it's likely to put some of the cut odds back in play. They'll be talking about a March cut again. And that'll lead stocks higher. The consensus is not for that cool print. It's actually expected to be hot. And there's been a lot of talk about how the easy monetary conditions is reawakening inflation. If we get that kind of reading today, it's going to add to the narrative that the Fed has already been holding, that they don't want to cut too soon, and that they need clear and convincing evidence that they've got this under control, which would reinforce the idea that there will be no March rate cut. And the market would very likely unwind the other 20% that's left to be unwound for that March cut. That would be weak S&P weakness or even bearishness. But those are two different things, right? So we don't have anything on the profile. It's no pattern like a D or a P. We're back to the point of control, which lines up with the TPO. Got a bit of an air pocket below down to 49.70 area. We're going to lose more of this volume through the lower middle end of this, but it's not really going to clean things up until the end of the week. And that's a long ways off. Here we have a classic B. And we've got a discrepancy between TPO and volume profile where the point of control is. This is TPO, time, price, opportunity. Call it volume by time. And that's your regular volume profile, volume by price. We have a new VPOC now overhead, which gives us a squeeze on each side. We've got a VPOC above and a VPOC below. It's very likely that we're going to hit at least one of these today, if not both of these today. It is worth circling back to that. So an event candle, there's no science behind this, right? No magic to it. Anything can be the candle that you want to study, but preferably it is based on something. So we'll just use CPI revisions from Friday. If this was the candle that we wanted to focus on, you want as much information out of this candle as you can get, and you want to project that information to the right so that we come anywhere inside that zone and it has something to offer you. Now, when we got that CPI print revision on Friday and that big bullish move to the upside, the base case argument was that we would close the gap. So we were looking for a downside move, not because we were bearish. We didn't expect price to go down because we were bearish. We just expected price to go down to get that gap closed. The bullishness resumed after the gap was closed, and we overshot it a little bit. Why did we overshoot the pivot? Because liquidity resides on the other side of the pivot. If this is where we were supposed to go, liquidity is on the other side. We're supposed to go through it. That's how we trap bears, and it's where the liquidity is at. It's like going to an apple orchard and only looking for apples on the ground. You want to go to where the apples are at. You got to go into the tree. If liquidity is on the other side of the pivot, price is going to go to the other side of the pivot to get to it. And as you see, I can map it out in both directions. Mapping it in both directions help, because if we do turn bullish again, which we did, then we have our halfback. We have our full level back to the top, and then the projection to the upside. Any candle can be a candle of measure, even the 5-minute open or the 5-minute Globex open if you're a nighttime trader. We had a lot of Bitcoin proxies yesterday making some pretty awesome moves. Coin, Hut, Mara, Hive, Riot, MSTR. We don't want to spend too much time this morning looking at what's up, or what's down, since all of this is going to change as soon as we get that CPI number. So really no reason to, crunch the numbers and push too hard to line out, equity opportunities. Having said that, Bitcoin is up. The FANGs are up. Excuse me, not up, down. Bitcoin down, FANGs down, semiconductors down. And there's nothing this morning other than what? Nat gas. Yay. And the ETN FANG down, FNGD. It's a triple leveraged short for the MAG 7. That's down. So we're constantly asking, is this the turning point? We're all looking for a ceiling, a topping pattern, something that suggests we're going to roll over. There is a statistic that exists about topping patterns, but we need a topping pattern first before that statistic kicks in. So we're constantly monitoring and looking and trying to ask that question. Are we topping out yet? Now, this is the MAG 7. We're on a daily, but we're sitting up at these highs. Put it on a weekly. That's not a topping pattern. It's just bullish. Go to the NY FANG weekly chart. It's just bullish. We're even still above the 3-week moving average, the 10-week, the 20. So there's this 50-80 rule. What's the 50-80 rule? Once a stock establishes a major top, there's a 50% chance that it'll fall by 80%. Whew. And an 80% chance that it'll fall by 50%. How's that for some numbers? But we got to have a topping pattern first. An 80% chance that it'll fall by 50%. That leads us to a halfback number, right? Which is something that we constantly focus on. Where's the halfback? Because it's an 80% chance that we're going to fall by 50%. It's an 80% chance we're going to the halfback. I know, right? Isn't that awesome? It comes from reading all those candle books that are very boring and that I think most of us didn't read, because it feels pretty stupid to read a candle book when you've already been trading. I know it feels pretty silly when I do it. Why am I reading this book? I'm already a trader. I'm already consistently profitable. And yet I can't help myself. I do it anyways, and I pick up another little nugget like that. This is growth versus value. And it's easy to look at this and think bull versus bear, but that's not true. All right. This is in a more simple version of this, it would be tech versus staples. And it's not that, but it could just as easily be that, right? And we could change the markets to look at tech versus staples or consumer discretionary versus staples. But at the end of it all, this is growth versus value. And technically speaking, when growth is doing good, the broader market does good, tech does good. And when this is pointed up, that's growth. When it's pointed down, that's value. Think of value as your Pepsi's, Home Depot's, Lowe's, Campbell's soup, ketchup, that kind of thing. Toilet paper, bourbon. So those are the kind of things we'd expect to do good when this is going down. And then your tech stuff, we would expect to do good when this is going up. We had our really good pullback yesterday, but we are still sitting at levels never seen before. And 1.95 was the last high that we had to get through, and we broke that ceiling with strength behind it. Not only did we have a down day yesterday that closed at the lows, we are gapped down significantly this morning. Now, we've gapped down before. There was a gap here where we jumped the 10 and we just rallied right back up again. So one gap down isn't really much of nothing, but it's a move towards the 10. And there's two ways to look at that. A 10 is where we get our reset, right? In a good bullish run, we want to come back to the 10 and get a reset for a continuation. But on the other side of that is when we get to the 10 and we break it and get underneath it, and then we're trapped underneath it. We make moves to continue to the downside. The difference between these back here and where we're at now is that the 10 and 20 crossed after the market had gone sideways enough to let that 10 come up to us. Here, we would need the 3 to get to the 10 after price has already crossed through the 10, and very likely after price has gotten to the 20. So it's unlikely to see it all unravel in a day, but this is one that's really good to keep your eye on if you're just looking for that broader picture of how's the market doing, growth versus value. Keep in mind that this isn't an either or proposition. Both growth and value can both be strong. This is just asking which is stronger. In a bullish market, when everything is doing good, growth and value are both rising and most of the broader market is going up, you're still going to have the ability to ask which one of you are stronger right now. So again, that doesn't mean bearish just because this starts to go down. It just means one is stronger than the other. Here's that new product, FANG up versus FANG down. Individually, they're both fine. I like to put them together in this ratio so that I have one single unit of measure, and then I can look at that and compare it against the NASDAQ, or in this case, the S&P. A little bit of a divergence. We had a sharper pullback in this grouping than we did in the S&P, and this morning it is gapped down significantly, which the S&P does not represent yet because it only works in the after hours, or it doesn't work in the after hours. So we can replace this with SPY at the bare minimum and see something that is responding in the after hours. Let's just make sure it's showing after hours. When it was just the SPX, I didn't need it to show after hours. But it's still not, right? So there's a little bit of a discrepancy there. It's a little bit of divergence. But as the morning wears on, we might see some of this play catch up. One of these is wrong, say it that way. So here's your consumer discretionary against staples. When this is going up, things like Tesla are doing better. Your Mag 7s are doing better. When this is going down, then your staples are doing better. I always refer to consumer discretionary as your frivolous spending. That's not technically true, but it's the way that I like to see it. It's your play around money, holidays, vacations, frivolous spending. You're buying things that you can live without because you want them and you have the money to buy them. Whereas staples are things that you need, right? They're part of what keeps the house running. So when this is going up, we expect the market to do good. When this is going down, we expect the market to be flat to sideways. We can compare that with the S&P in orange, just put the S&P behind it. And you can kind of see how that argument lays out most of the time. But you can see the divergence right now. The white line is strong to the downside, but the S&P never turned. It just kept going higher. Now, we are getting a little bit of that change. It's trying to catch back up. But that is where the divergence ended. They both started running back up again. Here's where things went a little haywire. So a minor divergence, and we seem to be getting back on track again. It turned yesterday as well. There's a lot of ratios out there. We can't go through them all, but most of them are showing the same thing, right? That we're not topped out yet. We don't have any sort of a topping pattern, and that most things look crazy bullish. But if you look at, unweighted market, like that RSP, without the weighting, things are not as good as it looks, right? So when this semiconductor bubble pops, that ought to be the end of this rip-roaring rally. It's not to say that we're going to fall afterwards, just that we'll, start to behave like a normal market again. Here's the equal weight S&P 500. So instead of having the Mag 7 bully it around, this is what the market looks like when they're all weighed equally. It's the ticker symbol RSP. Watch the clock. Guys, we got, about 23 minutes and we'll get data. It's the biggest thing on the table. And everything else that we're going to do today is going to be based on that candle that we get at 8:30. Be careful, be safe, have a good one.